The global economy remains strong and it's propped up by the global consumer. Excess savings are being held, but the consumer is now more savvy with their cash. Today we're going to talk about corporate earnings upgrades, what it means for the equity market and why the consumer is so strong. What we're seeing globally is positive earnings revisions. That is, analysts remain too negative on the outlook for corporate earnings and are upgrading their forecasts for the rest of the year. Where it's particularly strong right now is in the US. We're seeing earnings upgrades for the rest of this year and for 2025. Encouragingly, these earnings revisions are broad-based. More than 2/3 of sectors in the US are seeing these upgrades. However, unusually, the consumer looks to be particularly savvy with their cash. Sectors such as consumer discretionary are actually seeing earnings revisions negative. Now, in the consumer discretionary sector, there are famous brands such as McDonalds, Starbucks and Pepsi. These are corporations which have been unable to increase their sales, so have actually increased their prices. And it now looks like the US consumer is saying enough and is choosing to spend their money elsewhere. And this came through particularly in Q1 with earnings disappointments from these corporates who are now faced with a challenge, which is unless they lower their prices or do special discounts, they're unlikely to increase their sales. But it's all because the consumer with enough cash is choosing to spend it elsewhere. Now, if we go more global, we're actually seeing some encouraging data from Europe as well. It looks likely that the German contraction in retail sales is over and that the German consumer is now willing to spend more above inflation in real terms. Remember that the European consumer in particular is probably 2 or 3 years behind the US consumer because of the impact from inflation. So it's likely we're going to see a modest increase in real spending from both the European and the UK consumer this year as those tailwinds from lower energy prices feed through into a more positive consumer. Now, away from spending, inflation data remains encouraging. What we're seeing now across places like Australia, Germany and the US is that inflation is no longer falling, but appears to be settling in a 3 to 4% range. Now, this is very different from the pre-COVID era when inflation was below 2% in most countries. The fact it's so strong today is more an indication of this spending strength from the consumer and still some residual effects from companies trying to pass through large price increases. So the inflation impulse today is more a reflection of a strong consumer rather than the impulse we saw from rising global prices and these price shocks in places like energy and goods. So inflation, whilst low, isn't probably low enough to see material rate cuts in places like the US or Australia. We are likely to see some rate cuts in Europe, as my colleague Paul Durrance reflected back to you yesterday. However, these are more likely a reflection of the lower growth impulse in Europe relative to the US. However, all this in aggregate reflects a very positive backdrop for equities in particular. That is, consumers have built their cash buffers and are willing to spend where they think prices are reasonable. So all this is being reflected back from central banks who don't appear to be in a rush to reduce rates. That's all for today, but please join us tomorrow when we'll update you on some more US GDP data. Thank you.